No worries. Thank you very much, and welcome, ladies and gentlemen. James Ayers is my name. I cover Fintech as well as the banking sector for the Financial Review. I wanted to get started by asking Ian Pollari, sitting on the far end of this panel. Ian's the National Head of Banking at KPMG and also the Global Co-Head of Fintech. Look, there's a lot of policy change going on at the moment. We've seen the slides up there this morning of Rowena Orr getting underway again in Melbourne with the Royal Commission, but there's also Productivity Commission review into competition, financial services, and interestingly, the open banking report, which Stuart Stoyan's just spoken to us about before the coffee break. Ian, do you think those policy, with all the different balls in the air with respect to policy, how much of that is sort of going to move the dial, and what changes do you think it's going to produce for the business models of the major banks, and what opportunities might all that create for the fintech sector?
Sure, thanks, James, and good morning, everyone. Look, I think the first thing to say is that while the potential is certainly far-reaching in the context of the impact on business models, two of those reviews the Commission is still underway and still early, so we've got the second hearing commencing this morning. And in the context of open banking and productivity, it's still under consultation. So time will tell in the context of what's going to come from it in terms of permanent levels of structural change to the industry. But certainly putting that aside, if we look at the intent of a lot of the reviews and commissions that are underway, it's primarily twofold. One, around ensuring that the industry is aligned to the interests of customers, and secondly, around promoting competition in the industry. And certainly things like open banking, which have moved pretty quickly in the context of the Treasurer returning from the UK around 15 months ago with a real commitment to see it implemented here. It did go live in the UK around 3 months ago, and we've sort of had it described as being very transformative in the context of what it will do. We've also had it described as hype disappointment 3 months in. I think like anything, we tend to overestimate what the short-term impact is, but no doubt we'll underestimate how transformative it will be. But in terms of business models, I think what we expect to see is, business models will be characterised by an ability to really embrace advanced technology advances. We'll see, I think, a removal of unnecessary complexity in terms of the operating models of many financial institutions that often stands in the way of delivering a customer experience, and to do so in a way that's profitable for the business providing it. And then I think in terms of conflicts of interest, we're really going to need to zero in on any sort of perceived or actual conflict of interest that may result in unintended outcomes for consumers. I think there's some of the business model changes, and we can talk to some further dynamics at play later on.
All right, well, let's do that. I wanted to introduce Mark Bouris, ladies and gentlemen, who's one of the great disruptors of the banking sector in Australia as the founder of Wizard Home Loans. He's currently the chairman of YellowBrickRoad. He's on the government's Small Business Funding Task Force, and he's just about to launch a new television program called The Mentor, which is Australia's version of The Apprentice. So perhaps run for president sometime, Mark.
No.
But I wanted to ask you, Mark, we've just heard about all these policy reforms coming down the pipeline. The government's sort of trying to do what it can to pry open competition and get the fintech sector here firing. You were presided over sort of disruption in the mortgage broking sector with Wizard and Aussie Home Loans sort of going from like nothing to 25% of the market within a few years. Permanently changed the landscape in Australian financial services. If you had your time again, would you reckon you'd be able to sort of do that kind of thing again now?
Good question. Thanks, James. Well, what's interesting at that period, and we've got an inquiry at the moment, Royal Commission, but the Aussie Home Loans Wizard Rams phenomenon come off the back of the Campbell inquiry, which actually was about deregulating the market as opposed to regulating the market. The current inquiries are more about regulating banks, regulating brokers, making change to sort of stitch them up a little bit. And back then it was a bit round the other way. And what's interesting to me is we've got a coalition government who, generally speaking, is non-interference as a rule. Under hockey, that was definitely the case. I'm not having a crack at Treasurer because he's a good bloke. I like him. He's a friend of mine. But we are getting pushed into these environments. So to answer your question, as a result of deregulation, what that allowed people like, particularly us, Wizard, because we actually funded all our own debts. John was using the Puma platform, which was owned by Macquarie, and he also brokered. Whereas Wizard, we used our own platform, which is ultimately the one ended up now with Pepper own it. and we raised our own money. And we could raise money flat to CBA. So whatever CBA raised money at, however much money they raised, we could raise at the same price and the same amount. And we generally speaking did it overseas. And that allowed us then to deliver product to consumers to get a good consumer outcome. We had good distribution. We were able to deliver product to consumers at a price which was below the banks. And we knew what the sensitivity was, James. It was a 25 basis points difference. So but
that's very different to where things are now, right? If you're a non-bank lender or alternative lender, you're looking at a big premium to bank funding. Even if you're a regional bank, you're looking at a big premium.
Correct. And the GFC made sure of that, and Swan's response to the GFC made sure of that. And I must say, at the time, it was the right response because I was on the Financial Service Advisory Council to Swan at the time. And he did that for financial stability. But now what we've got is the big four guys, maybe the big five, but definitely the big four guys, who control all the funding. And there's just no way in the world that YellowBrickRoad today could go into the market and provide a product or buy money or get money flat to what the banks get the money at and lend it at 3.7 for a prime loan and make money. We just couldn't do it. So we have only one way to proceed, and that is actually resell, just be a broker. And that's not a great business model, and that doesn't get very good outcomes for consumers because we're not offering them a better price.
Okay. Gerd Schenkel, ladies and gentlemen, just sitting closest to me, he was the founder of UBank, which is owned by NAB. He was the founder of Telstra Digital, and he's recently just left a position as CEO of Tyro. He's currently now managing director of BGA Digital, his own consultancy. Just in terms of responding to Mark there, like you've had a lot of thinking about how to compete in small business banking against the big four as head of Tyro. It's been tough for Tyro. It's taken a long time for them to sort of make any inroads in the terminals market, and now they were trying to have a crack at small business lending. I mean, what do you make of those conditions? Are any of these policies that we're seeing coming down from Canberra going to move the dial?
Yeah, look, it's it's tough because of the concentration, and that's on the funding side, as Mark was saying, but also in the case of Tyro, merchant acquiring is extremely concentrated and tightly intermingled with other product sets. So whilst you can have a superior product, doesn't mean you're going to be successful necessarily. And in fact, we've seen very, very little new entrants of any scale right across the spectrum. And really, what we're seeing, and a lot of you guys in the room will do that every day, some degree of activity in subprime, unsecured small business, really sort of risky ends of the market. They're actually very, very small markets. They are quite risky. You can sort of make a gross margin, but you have to fund it with equity or some other kind of really illiquid, obscure, high-cost funding source, which ensures that the moment you become relevant and gain some form of scale, the banks will be there waiting, right, and taking their cut. And that is a really big issue because you can spend 2 or 3 or 4 years doing awesome work, right? Putting good technology down, building great customer experience models. But just as you become relevant, it's kind of the end of the road. And sometimes being acquired might be a success factor. But in the interest of competition and real choice for consumers and small businesses, it doesn't achieve that. And we see some of that now in the UK. Some of the celebrated models are sort of now sort of exiting or kind of selling or half selling or slowing down. Now, you might consider that success if the founders walk away with a good return, but it doesn't structurally change the industry, and the regulatory environment here is actually quite far behind. So you have capital markets interest in fintech sort of past the peak, I suppose, still there, but past the peak. Regulatory activity here is relatively slow, and therefore, we're really not seeing what is now possible technology-wise, to come to bear in Australia at the right scale.
Ian, just in terms of the UK, like you have a position sort of looking across the globe in your position as a sort of global co-head of Fintech. Do you get the sense that the UK incumbents sort of have won that battle against Fintechs? Gerd's talking about sort of acquisitions happening, and maybe that's a win for the particular Fintechs, or do you think that the perhaps structural shifts to the industry might take a little bit longer to play out?
Yeah, I think in short it is going to take longer, and certainly we'll see where we are in 12 months' time with the benefit of read and write functionality in the context of open banking in the UK, which will be different from certainly the direction that the Australian regime is heading. To Gerd's point, there's been over 40 bank applications granted or in the process of being granted, and the reality is, with the exception of a few, a lot of them haven't really been able to prove that they've got sustainable economic models. And a function of that is being able to get access to cheaper funding. No doubt a lot of them get an early level of adoption through their application, their customer engagement, and that's kudos to them. But you can't build a business model just on great CX. It needs to be the right mix of product, and I think that's another dimension that we're starting to see some of the larger fintech companies in the UK recognising the need to move in areas such as mortgages to really give them greater levels of profitability, and secondly to ensure they've got the right partnerships or an ability to raise funds at low cost.
You're talking about the sort of UK neobanks. Like in Australia, APRA's changed the licensing regime recently to introduce sort of phased application process for startup banks out of the budget last year. Gerd, like, how do you think that's going to play out? I mean, do you think any of those models, there are a few popping up, are they going to get any traction as deposit takers?
Yeah, look, on the APRA licensing approach, APRA's doing its job, which means securing the funds of deposit holders in Australia, and that means not giving licenses out. So there's a real conflict in the intention of providing better conditions for new entrants and keeping mums and dads' money safe. They're both honourable intentions, but the licensing lever might not be realistic. Specifically, the proposed phased licensing, I think, is a complete waste of time for most startups, not all probably, but if you raise $50 or $60 million, which ultimately you have 2 years to do, you can't touch it, you have to produce a return on that equity. That just makes your business case much harder, if not impossible, to do. So the 2-year phased license is a fixed term. If you do not get a full license at the end of 2 years, your license disappears and you have no business. I don't see how you would raise equity on that condition. It just makes it harder, not easier, I think, for people to be successful. You're better off going into a business model that doesn't require retail deposits, make that work, get some scale, get some flow. Later on, you might get a license, but why would you start with the hardest thing, with the biggest hurdle in the industry? I just don't think it really helps.
Ladies and gentlemen, if you've got any questions, just put them through the app and we're happy to answer them. We're just going with the flow a little bit here. I'll bring Mark back in though. Mark, you were talking about sort of cheap funding cost is a crucial thing in order to be able to compete. It comes down to funding and the ability to get cheap funding. Some global companies that have that cheap funding are the big global technology companies. Look at sort of the amount of cash, the amount, the low rates that your Amazons and Apples are able to raise funding at if they so wish. Do you sort of look at that platform economy, the rise of these massive tech giants, Amazon coming into lending in the UK, for example, it's a non-bank lender. Do you look at that and say, oh, maybe those guys might be able to move the dial a little bit if they so decided to come in aggressively?
Many years ago, and I can't remember his name, it's terrible, but the CEO of NAB used to always say, what was the thing that kept him awake at night?
Klein?
Not Cameron, way before Cameron, it was about 2000, and he said the thing that kept him awake at night, and he was reminded of this many years later, but the thing that kept him awake at night was General Electric coming into the market. Now, General Electric so happened to be the company that bought Wizard, but General Electric did come into the market, and General Electric bought Wizard, and what they were able to do was they could actually borrow money, US dollars, converted into Australian dollars, but they had natural hedges. They're actually able to borrow dollars in the US sub-LIBOR. So, if you're an organisation in America that had to invest in commercial paper, you had to buy General Electric paper and you would buy sub-LIBOR. Now, this is the same sort of concept with Amazon, etc. These organisations can raise money really cheaply, and obviously they've got lots of access through their portals. But what's interesting, though, is when you get an organisation with General Electric, as soon as the market turns a little bit, they say, no, that's not my core business, and I'm out. And I think there's every opportunity, every chance that someone like Amazon, etc., will be looking at these sorts of environments, but it's not core business for them. That's not their core business. And I wonder whether they would know about the sort of the downsides and the risks of organisations like General Electric. As soon as General Electric lost its rating, its ability to raise money sub-LIBOR, it was out of the market, gone, out. So my gut feel is they're looking at it, they're wondering, they're thinking about it, but particularly in Australia, they probably think to themselves, yeah, maybe put that on the back burner, we're doing well enough.
It's probably most likely that lasting structural change does come from an international entrant, be it irrational or rational. So SoFi, for example, announced a launch in Australia. I don't think it's launched. SoFi, very big, very successful in the US, raised $1 billion equity. And they have technology platforms and other things that they could leverage down here potentially. Obviously, the ones you mentioned. It would be a shame if the lasting change in Australia were to happen by an international company, because we do have the talent, we have the smarts, we have the size of the market. It would be a real shame if some of that value floated offshore once again. So that's kind of one of the joint objectives, I think, of the regulator, the industry, to compete with that effectively and have at least a few homegrown scale businesses.
And it's interesting, Judge, you know, I mean, the Royal Commissioner at the moment, and also the Productivity Commission and every other inquiry, I think they're looking at, well, they might not be looking at the wrong things, but one of the things they're not looking at is exactly this whole topic. How do we unlatch that stranglehold that the banking system has on funding, such that everyone in this room who's coming up with some sort of new technology which is going to get access to customers and get better customer outcomes in terms of customers understanding their data, etc., whether it's through open banking, we need to work out how some commission needs to work out how we're going to get there. We should hold a commission in this room today. We'll cover an answer by the end of the day.
Maybe it'd help if the ratings agencies didn't apply a sort of implicit rating guarantee in terms of government support in a crisis, because that lets the banks wade into the capital markets and raise money very cheaply.
Too big to fail.
I wanted to just come to these questions. That's probably a good one for you, Mark. I'll bring you back in just a tick, Ian. But what do you think about sort of AFG and the big loan aggregators? There's lots of small business fintechs in the room seeking to sort of break into that lending space for business. But this is sort of a question, I suppose, looks like it's related to home loans. What do you make of aggregators?
Well, it's interesting because most people would know YellowBrickRoad owns the third largest aggregator in the country, a company called VOW. We do about $1.1 billion just through VOW, $1.2 billion a month. My view on it is that aggregators are going to do it tougher and tougher. And the reason for that is that the compliance regime is starting to get pushed down into the aggregator level from the banks, and probably as a result of the Royal Commission to the aggregators. I'm not talking about bank-owned aggregators, I'm talking about every aggregator just across the board. So our level of compliance at VOW has probably increased by a factor of 10 over the last 2 years. So we're now doing all the compliance work in terms of accreditations and the ongoing education of all the brokers. We got 1,100 brokers. 1,500 brokers, across Australia. And so what's going to happen is we don't make much money anymore because they took away volume bonuses, they took away all the sponsorships. All we do get now is the commissions, and the commission mostly gets passed through as an aggregator. It's a full pass-through. Sometimes you get a little bit of it, not much. And really what you do charge is just a platform fee. And the platform fees are not enough today to cover all your other expenses, whereas they were a few years ago. So aggregators have to get out and renegotiate platform fees. And I think what's going to happen as a result of that, irrespective of all the inquiries, a lot of the brokers are going to say, well, I don't make enough money if I have to start paying a whole lot of platform fees, additional platform fees, I should say, to cover compliance costs, the extra compliance costs that's getting imposed on us by people like ASIC. So therefore, I think the future of aggregators is that there's going to be a massive consolidation of the aggregators in the marketplace. Now, I'm talking about AFG, I'm talking about Connective, I'm talking about our business, VOW, I'm talking about Aussie, I'm talking about RAMS, Mortgage Choice, the whole lot of them. That's what I mean by aggregation, all of those. And I think there's going to be consolidation. And we're already seeing some share price, where they're listed share price, pressure on some of those companies.
Right. I think I would add, this comes at a time when we're going to see aggregate levels of growth in the mortgage industry go from 12% compound average over the last 20 years to around 3 to 4%. So it's going to come at a time when the reality is the cost of originating a mortgage, which could be $2,500 to $3,000, currently will need to significantly change. And so the technology will play an important role in that. I certainly have the view that there absolutely is a role for broking in the industry, but it needs to be built upon an ability to deliver it at scale, at low cost, through smart tech.
I'm going to ask you, Ian, a combination of these two questions at the bottom of the screen. Sort of global demand from the equity and debt capital markets into fintech, and then you're also seeing these huge global players, KKR's acquisition of Pepper, that's off the public market now, Blackstone's sort of floating around as well. What do you see when you look at global demand for local fintech or local non-bank lenders? Do you see more M&A deals coming in that space?
Yeah, look, certainly as we look at the sort of more contemporary development of fintech in the last 5 or 6 years, we've seen a significant increase in the level of investment in fintech. So globally, last year it was $31 billion in US dollar terms, and in Australia was about $1 billion. So we've seen that rise phenomenally. I think we're starting to see more concentrated bets now. So those companies that may have been founded 4 or 5 years ago are certainly beyond sort of Series A, now getting into Series B and C, and they're looking for bigger tickets. And conversely, investors are looking for now, I think, demonstrable evidence of business models that are winning and supported by entrepreneurs who they can genuinely back. So certainly while we've seen a drop-off in the overall level of year-on-year growth, which I think is actually positive, I think we're going to see larger deal sizes. The implication for that is I think we're still going to see challenges in that Series A, Series B category, which we'll need to sort of turn our minds to. I think the second question around the entry of the KKRs, the Blackstones, etc. I think it was back to sort of Mark's question or response to your question, James, around how would a Wizard sort of applied in today's market evolve. I dare say it will evolve with the backing more likely of one of those players, and it's interesting that obviously you sold your business to Pepper and now obviously Blackstone is a key fund or a balance sheet provider, KKR. So we certainly feel that there is room for that, and it makes a lot of sense. You've got big balance sheets looking for yield in a market that they understand, and certainly you've got the likes of Pepper and others that have got distribution, customer bases that allows them to scale quickly.
Look, I promised to stick to time. We've only got a little while left, but I might just end with you, Gerd, just on this IPO question at the bottom there. Prosper's obviously looking to do an IPO, so perhaps the question is talking about that. You might want to talk about them specifically. We've also seen Afterpay, get into a bit of trouble over the last couple of weeks on the listed market, just around some of the and the responsible lending types of issues. Maybe they'll come back, but maybe what's your thoughts on how the IPOs, sort of public markets, will respond to fintechs, either those newly listed or ones coming up, going to be well received?
Look, I think there's demand for fintech IPOs in Australia, which is why there's huge interest in the pre-IPO space, and we have a very small list, very short list of what you might consider pre-IPO or just post-IPO. So you mentioned Afterpay. Prosper's talked about, Tyro's being talked about, but Tyro's a 17-year-old company.
And Society One's been talked about for a bit.
Society One. Now, there's a short term and a longer term. Personally, I'm very scared of new young books in the unsecured space. You don't know what's in there until you have a full cycle, and we haven't had a full cycle, so you really don't know the credit quality of what you're buying. So you need to have a risk appetite commensurate with the lack of really knowing what's going on there. But that might still mean those companies could be having a very successful IPO because there's huge demand to exposure to the sector. I think the real issue is that we don't have a lot of them. Look at OzForex. OzForex IPO'd quite a while ago, but is one of the larger fintechs in the country. There's not a lot of interest. A few years later, people don't talk about the company anymore, but OzForex is still one of the sort of grand, masters of the first wave of fintechs before we had the term. I think we need to take a longer-term view of all of that, as opposed to the IPO bump that's kind of very American in its perspective. We need to build lasting businesses that can reach a scale, which means they need to be able to IPO but continue to deliver. So, Afterpay, it's a difficult business model, right? They've done an incredible job executing what they did. Lots of competition, lots of regulatory pressure, not surprisingly. But in the end, you buy the team, and the people I met from Afterpay were terrific people. I don't own any of those stocks, by the way. But it's very hard to predict, obviously. So you might invest in a leveraged index fund instead. I don't know.
All right. Well, look, on that note, we're a little over time. So would everyone please join me in thanking the panel? I hope you've enjoyed it.